Hello guys, this is Rob Conley with Nova Star Trader, here giving you guys an introduction to Forex trading. Um, we're excited today to give our first video lesson to all those newbies in the market, those that are eager to learn about trading in the Forex market. And so here we go, let's get started. We always just start with a disclaimer. It says, by viewing any material or using the information within, you agree that it is general educational material and you will not hold anyone responsible for a loss or damages resulting from the content provided here. This is very important because you have to know before getting started that 90% of traders lose their money. I will repeat that. 90% of all traders, speculative traders, I will say, lose their money. And there's so many reasons why. Some people they don't have the patience, the stamina for trading. When they see a trade going against them, they like to close the trade. And if you do that every time, you're going to lose a lot of money. Some people are gamblers. You know, they bet big and think they're gonna win big. They're not managing their risk in their accounts properly. They're over leveraging their account. And then I would say a large majority of people just don't know what they're doing. They weren't taught. When I first got started, I definitely lost money. And that was mainly because I did not know what I was doing. I saw the ability to make a lot of money fast, and that was overlooked by the opportunity to lose money fast also. And so that's why we have this last line. It says, no representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this material. The past performances of any trading system or methodology is not necessarily indicative of future results. Guys, this is very simple. I mean, we have services where we provide traders with trading signals. And we've been very successful at this, so we provide signals to traders. Well, some traders don't know that just because we provide you a signal, well, they know it, but some traders, they don't handle the fear and the greed well. And that's what this market is about, fear and greed. You know, greed will cause you to, the market could turn against you because the market goes up, down, up, down, up, down, and it could turn against you if you're too greedy. So just have this disclaimer in here just to give you guys an understanding of what this market is about. And hey, there's a lot of risk involved. If 90% of people are losing their money, then there's definitely a lot of risk. Why, who, what, when, where, and how? All right, so what? This Forex exchange market, better known as Forex or FX, is the largest financial market in the world. It was once said that this market was trading $7 trillion with a T. Now this market, I think, is down to the $5 trillion. And I don't know what was the cause for that downturn, but even at $5 trillion, it's still the largest financial market in the world. Why do we trade this market? Simply because it's volatile, it's high liquidity, low transaction costs. This means that you can get into a trade and let's say you can make upwards of $500 to $1,000 and only spend $8 to make the trade. Of course, you can make more than that, but to have a chance to make $500 to $1,000 and only spend $8 to do that, hey, that's what I call low transaction costs. 24/5. We're talking about a market that opens Sunday at 5 p.m. Eastern Standard Time and closes Friday 5 p.m. Eastern Standard Time. So A lot of times the trade, unlike stocks, stock market opens at 8:30, closes at 4:30. So you got a small window to trade. Forex market, you can wake up in the morning at 3 a.m. when the London session is kicking off, and you can see a lot of liquidity and volatility in that market during that time. Who? Large banks, commercial companies, government, central banks, and speculators. Large banks play a part in this role. They trade this market. They also use your money when you go from Atlanta to Italy, for example, or United States to Italy, and you purchase that. You buy something in Venice. While you're there, your money is being is playing a role in this market because you're transferring your dollars, you're converting your dollars to the euro at that time of the purchase. So think about all the travelers in the world that's traveling from country to country, using their bank to make those, using their debit card to make those transactions. You also might convert your cash. You got commercial companies where, let's say Apple, big company in the United States, manufactures their products in China. So they're spending millions of dollars in the converted currency in China to conduct their business, to manufacture their products, paying for labor. All of those monies spent in China to manufacture those products is playing a role in this foreign exchange. The government, we just had a rate hike on Wednesday of this December 5th. What was it? It's in December. I think it was today's the 16th, so it was the 14th, 2016. Had a rate hike. Federal government came out and said they're gonna raise the rates yesterday. They raised them a quarter of a base point, and they said that they're gonna raise them in 2017 upwards of 75 basis points. So naturally, the dollar got stronger because of inflation. And when the dollar gets stronger, that also influences commercial companies and their ability to do business abroad. So a lot of stuff goes on, and then you have speculators. That's us. That's the people that are making trades. We are speculating on the market's change. We're speculating on the trends, and we're placing our trades based off our indicators and our speculations. All right. When we talked about it Sunday, 5 p.m. to Friday, 5 p.m. The how is very simple. You find a broker. It's going to take you about 7 days to open an account. They ask for your passport, social security number for those in the United States. They want to get some background information on you just to make sure you are who you say you are, and you're not laundering any money or anything like that. You open your account. Hey, you deposit your money in your account. If my account is open today, I can deposit money in 5 minutes, and then I can start trading in 10 minutes. It's very easy to get in. And so that's an attractable way to trade this market also, because it's easy to get in. But if you don't know what you're doing, you're gonna lose your money. I mean, I hate to say it. You may have beginner's luck. You may have a day, or you get started and make a lot of money. But hey, at the end of the day, you're going to lose, because that's just the nature of the beast. All right, let's get into some good information here. There's 3 types of market analysis, all right? And you have technical analysis, fundamental analysis, and sentiment. And this is how I like to look at these 3 pillars of trading. let's start with fundamentals. All right. And this is an analogy I like to use. Okay. You're feeling sick, right? You're at home, you're feeling sick, your nose is stopped up. Maybe you have a slight earache. Maybe you're coughing a little bit, right? So you call your doctor. You say, "Hey, I'm having sinus problems. My nose is stopped up. I got a bit of a headache or head. My head is bothering me. I can't breathe out of my nose. My ear is hurting a little bit, coughing a little bit." Those will be your fundamentals, right? Those will be your fundamentals analysis for whatever your problem is. Okay. So now you go to the doctor and you say, "Hey, doc, you're in the doctor's office," and now the doctor begins his technical analysis of your symptoms. Okay. So now he takes the stethoscope, he puts it on your chest, asks you to breathe in deep breaths. He looks inside your nose with that light, check your nostrils. He's looking in your eyes. Then he goes to your ear. He put that scope in the magnified finger thing in your ear with the light, checking your eardrum, seeing if there's an infection. Goes to the other ear, does that. Puts his hand on your stomach, checking your stomach, seeing if there's anything there. He's performing a technical analysis, right? And so, talking about sentiment, before he performs that technical analysis, he'll probably ask you this. He or she will probably ask you this question: how long have you been feeling like this? Um, have you just recently started feeling like this? Have you been feeling this way for the past 2 days, or has it been 2 months? Um, how severe is it? Is your throat hurting a little bit today, or is it hurting extremely a lot today? What severity of pain are you in? And so to translate that to uh, trading, the fundamentals would be something like a rate hike. Okay, the Feds come out with a decision that the rates are going to hike and they're going to go up. Okay, well, more often than not, if I'm looking at the charts, I can pretty much tell if the Fed is coming out with some major news. I can pretty much tell what they're about, what's about to happen with this market based off what the charts are telling me. I mean, the rate hike would be the cause for what's about to happen and the volatility that's about to happen in the market. That would be the cause of it. But the technical analysis would be the meat and potatoes. That's going to basically tell me what's going to happen when this rate decision comes out. I got a pretty good indication of what's going on in the market. Sentiment will tell me in trading terms what's going on in this market. Is it trending? Is it ranging? We'll get into that in a second, but is this market trending? Is it ranging? Is it at the beginning of a trend? Is it at the end of a trend? That's what I mean when I say market sentiment. All right. So those are the three pillars that are vitally important before you place a trade. You have to have an understanding of all three. And if you have an understanding of all three, it's going to help you to have success in the trading market. All right, going in depth with fundamental analysis, we talk about reports released by the Feds on U.S. home sales, interest rates, monetary policy, any type of, if Yellen is speaking and she's speaking about something related to monetary policy, there's going to be some volatility in the market. And it's very important that traders understand all news events. When Yellen is speaking, when the federal government is releasing information, you have to know when that is, because those are the times when the market is going to be most volatile. When I first started trading, I wasn't aware of all the news events per week. And I might place a trade. I might be trading the 8-hour chart, and I'll place a trade, and I'm going about my day. I'm not watching my phone all day, and yelling or someone is speaking or there's a major news event, and my trade goes against me, and so I look at my phone, and I'm looking at, I might have been up $300, and then I look at my phone and I'm down $700. I'm like, oh God, what happened? It looked, the charts was telling me this. What happened? Well, what happened was there was a major news event, and it's gonna move the needle dramatically in that market you're trading. So it's very, very important for you to be aware of all the major news events. Some of them have high importance, and some of them have medium. Not all of the news that is released per week are very important. Some of them have medium importance, and you just have to know which ones are going to move the market. But here's a few of the fundamental analysis that you should be on the lookout for when you're trading, and have a good understanding of it. The growth domestic product of your pair or your pairs that you're trading, you should have a good understanding of those. Interest rate reports, you should know when they're releasing those. Monetary policy and inflation, which is what we just received this month, and our interest rates. It's good to know when these come out, because it makes the market volatile, and you have to know, if you have money on the line, what's going on with your pair. Trading the news. I put this slide in here just to give you guys an understanding. This was a trade for this week, as a matter of fact. We traded, this one was after the market on the left. This was after the rate hike. Okay, so the rate hike was on the 14th, and it was at 2 o'clock. Okay, so the news came out at 2. We placed our first trade, as you can see, 214 at 551. All right, you see that? The second trade down on the left, we placed our first trade at 551 Eastern Standard Time on the day that the news broke. All right. The market got wild. I mean, it really got wild. But once it settled down, the rates and this pair was trending upward. We placed a buy order, and we made a nice little chunk of change. The reason why I have this slide in here is it gives you an example of, now, granted, we did trades with a larger lot size on the left, and we'll get into lot size. But as you can see, we have 400K, which equals like $440. We've traded $40 on each of these trades, versus the other one on the right, which is $20. Okay, but I put this slide here to show you how much more money you can make. This is not a great comparison because the lot sizes are different, but when the news come out, you can make a heck of a lot more money than you can when it's no news and it's just a normal trading day. The volatility and the capability on a day where the feds are releasing news or yelling and speaking, or any of the leaders in the financial industry are speaking, it really has a dramatic impact on your pair that you're trading. So this is just to give you an idea. I could have put a better slide in with better numbers, but I just want to give you a difference in numbers versus trading in news. All right, market sentiment. Market sentiment here you see, as we talked about, one of the most important questions you ask yourself before you place a trade is who's in control. All right, whatever market pair you're trading, you have to know the answer to this question. Okay, because if you do not know the answer to this question, more likely you will not be successful in your trade. All right, you have to know who's in control. Is it a bearish market? Is it a bull market? That's what I mean when I say who's in control. Are the sellers in control or are the buyers in control of this market? Okay, because if I know who's in control, then that lets me know how I need to trade. If I do not know who's in control, then that should tell me one thing: this market is ranging. Okay, so that there are trending markets and there are ranging markets. Okay, so it's important to know. It's important to know whether it's an oversold or overbought market, because those are the times that I want to place my trade. I want to place my trade when the market is either oversold or overbought. You heard the term buy high, sell low. I'm sorry, buy low, sell high, and buy and sell high. And I'm sorry, buy, sell high, buy low. Okay, so you've heard that, and that's no different here. You want to buy or sell in the oversold or overbought markets. Candlestick analysis, very, very important to trading. What are the candlesticks telling me? What are they telling me about my pair? What are they telling me about this trend? Is this trend about to change? Well, if it is, how do I know that? What is the candlesticks telling me? And we'll get into that a little bit later. And then, of course, we talked about the major news events. When we talk market sentiment, you have to know the news, what's going on in the market, and what news events are coming, because then you can kind of predict what's happening next. All right. So make sure we have a good understanding of that. Candlesticks, here it is, guys. I'll tell you, when I first saw this, when I first started trading, I really didn't understand it. Okay, but I'm gonna see if I can help you guys understand. All right. So here's the body, and let's say, for example, there was a candlestick here, right? And it closed right there, right? It's an ugly candlestick, bear with me. All right, so let's say the candlestick is like this, all right? This candle opened here, and then it closed here. All right, this one closed here. Now this one opened here, right? So this candle opened here, maybe it went down to this area, and when it got to this point, buyers came in and said, you know what? On this particular candle, let's say these candles represent one day. Let's say this is a daily candle. All right, so this was a daily candle, and this is the next day candle. So the market goes down to this point, and it says, you know what? At this place in the market, I am not having that. We're gonna buy this market back up. All right, they're gonna buy this market back up. So it bought it back up towards the open, and it went all the way up to here. All right. Well, on this particular day, the market got to this price point here, and sellers said, you know what? We're not having that. We're pushing this market back down, right? And let's say the market came back down into this area, and then whatever happened throughout that day, the market ended up pushing back here and closed at this price point right here. All right. So this gives us a perfect example of what happened in the market on this particular day, because we're saying this candle represents a daily candle. And everything related to this candle is important. Where buyers decided to stop this market from going down and push it back up is important. Where this candle opened is important. Where this market was pushed back down from this point was also important. Likewise, it was important when the market came back down and closed at this point. This is very important. I will tell you guys this. The most important part of these candles is this right here. Write this down, circle it, underline it. The most important part of these candles is the close. I can't say that enough. It's not the open. It's not the wick. It's not the high, it's not the low. I'm not saying it's not important. Now, the high and the low is important. The open is also important. But the most important is the close. All right? That's a freebie. You guys will appreciate me later for that one. But that is the most important. So, okay, this candle. All right, let's say this was the next candle of the day. All right, this one closed here. This one opened here. All right, this one opened. And let's say, for example, it went up, it opened, and it went up here. The buyer said, the seller said, at this price point, we're not having it. Push it back down, push this market back down, push it all the way back past the open, down here into this region. All right. And when it got here, buyer said, nope, we don't like that price. We're going to push it back up. No, it could have gone all the way back up to here. We don't know. It's closed now, so we don't know what happened in this day. But it could have gone all the way back up to here before it finally came back down to here and closed at this price point right here. All right. So again, looking at this candle, we know the most important is the close. All right. So that is something that we must know when we're trading. Pay close attention to all the closes of candles. All right. Very important. Let's see. All right, time frame. As we talked about previously, we used a daily time frame to illustrate that last example. But you have to decide what the correct time frame is for you. This comes from trying different time frames out, recording your results and analyzing those results to find what works for you. Okay. I say that because for us, we've been trading for a while, so we trade the monthly, the weekly, and we trade the daily. It's very rare that we will stay in a trade longer than, let's say, 4 or 5 days, but there are times that we will do that. That being said, we pay attention to those longer time frames because we've been doing this for a long time. When I first started trading, I was paying attention to 30-minute and hour chart because I didn't have patience, which is very important to trade in this market. I didn't have patience, and I was always watching the market. I was always watching it, and I wanted something fast-paced. And so you have to know what you want, and that's going to change as you grow your knowledge and understanding of the market. When you first get started, you're probably gonna want to trade 30 minutes to an hour because you're gonna like it. You're gonna like the opportunity to make money, see yourself making money. Now, this is considered that you guys start in a demo account. It's suggested that you start in a demo account. And even if you see yourself making money in a demo account, it's as rewarding because you're seeing progress, you're seeing profit, you're seeing results. All right. So it tells you in your mind that, hey, I can do this. All right. So once you start to see that, it's going to be appealing to you. And sometimes for beginners, it's hard to trade a longer time frame. Those are for people that's been doing it for a while. But you have to know yourself. If you're more patient, then you may like trading a longer time frame. But if you're not, and you're not a patient person, you might want to start the 30-minute to an hour time frame. All right. It says make it a habit to look at multiple time frames when you trade, and that's why I said we trade the monthly, the weekly, and the daily, because we don't just rely on one time frame. Before I make a trade, I'm looking at all of the time frames. I'm looking at the 3 hour, I'm looking at the 6 hour, I'm looking at the hour. Sometimes I make my trades based off the hourly chart, but I'm also looking at the weekly and I'm looking at the daily chart to see how I'm going to trade. And you have to know that if you're looking at a monthly chart, that's like a macro. A daily chart, an hourly or 2 hour chart is like a micro. So there could be a downtrend on the hourly chart. There could be a downtrend. But from a macro level, from a high level, from a monthly perspective, the trend could be up, going upwards. But the hourly chart is a downtrend, which means that if the monthly chart is an uptrend, that downtrend that you're seeing on the hourly chart is a temporary trend. It's not long term, because long term, from a macro level, as we zoom out and look at it from a bird's eye view, we know that the trend is upward. So that's a very important to know when you're starting out trading, because that's something I really didn't understand. I didn't understand how that could be one trend on this chart and there's a different trend on another chart. Well, that's come from looking at a bird's eye view. And this is something that's simple, but once you understand it, it makes your trading a lot easier, right? So here's a simple analogy, right? In an 8-hour chart, you know that there are four 2-hour candles. All right, so if we're looking at an 8-hour candle, there's going to be 4 2-hour candles that make up that 8-hour candle. Likewise, in an 8-hour candle, there's going to be 2 4-hour candles that make up that 8-hour candle. So if I'm trading the 8-hour chart, I might want to pay attention to what the 4-hour candle is doing, and that'll give me an understanding of what's going to happen with this 8-hour candle. And that's going to give me a high probability of making a solid trade based off what's going on in this 4-hour candle. Okay, so and that goes, on and on, depending upon what you're trading. If it's a 6-hour candle, you know that there's 3 2-hour candles and there's 2 3-hour candles. So simple stuff that we already knew in grade school, but when it comes to trading, very important. All right, time zones. Let's see, over here. Yep, time zones. All right, this is also very important to note. Sydney time frame. I have that here, but this just gives you an idea of when the players are in the market. All right, so you see here that let me get my. All right, so you see here at 3 a.m. we have Sydney, we have 3 a.m. we got the London session, and we have these two from 3 to, let's say, we have the Tokyo session starting at 4 a.m. All right, so as you can see, at 4 a.m., from 4 a.m. to, let's say, 12 p.m., we have all 4 of these sessions in order. All right, so from 8 a.m. to 12 p.m., that's when the market is most volatile, because we have all of these markets trading at the same time. All right. So you have to know this. This is very important, because this lets you know when the market is going to be most volatile. Now, it depends on your pair also, because if I'm trading the pound and the US dollar, now I know from 3 to, let's say, 12 o'clock, there's going to be, because from 8 a.m. to 4 p.m., there's an overlay of these 2 sessions. All right, but at 3 a.m. is where it's going to start being. This is their 8 o'clock at 3 a.m. Eastern Standard Time. So I know at 3 a.m. it's going to pick up, but around the closer I get to 8 o'clock, so I would say anywhere between 5 a.m. to 12, this market is volatile. All right, if I'm trading the pound and the US dollar. Now, if I'm trading the dollar and the yen, we know that this market opens at 4 a.m. So from 8 a.m., I would say a little bit before. I would say around 5 a.m. to 5 p.m. That's a good 12 hours of good trading right there. If I'm trading the the yen and the US dollar. All right, so know your pair, know your zone, trading zone overlays, because those are the time frames where your market is going to be most volatile. Very important to know. All right. Does that mean at 9 p.m. at night, if I'm trading the yen and the US dollar, does that mean at 9 p.m. at night the market is not going to be volatile? No, because this is a 24-hour market. Keep that in mind. I'm telling you that during these time frames, it's going to be most volatile. That does not mean there's not good trades made at 9 p.m., which is after. This market opens at 7 p.m. and it closes at 4 a.m. I'm sorry. So this opens at 7 and closes at 4 a.m. Does that mean at 4 a.m. This market is dead? Nope, it doesn't, because there's people in London and the New York session that's trading the US dollar and the pound. In the yen. So it's important to know the overlays, but it's also important to know that when your pair is traded and when it's most volatile. And I'll tell you guys, the most volatile times to trade is anywhere between 4 a.m. 3 to 4 a.m. to 5. 3 a.m. to 5 p.m., the markets are most volatile. And in between 3 a.m. to 5 p.m. Eastern Standard Time, though, the absolute most volatile is between 9 a.m. and 12 p.m. Eastern Standard Time. That's for all pairs. The New York session is the most traded time frame. That's the most traded time frame. So keep that in mind. Very important to know. All right. Lot sizes and pips. Okay. Lot size is the unit measurement of an amount of leverage you will use to place a trade at one time. Okay, so with leveraging the Forex market, you have the option to leverage a lot more money than you actually have to spend. Okay, you have the leverage to trade with more money or a higher unit size than you actually have in your account. So for example, the example I showed you guys back here where I showed you here, where I had, second, get my cursor here. All right, so I'm trading right here with $400,000. That's what 400K is, a 400,000 unit size. All right. So that means that in this particular trade, I'm occupying 400,000 units for this particular trade, right? But in actuality, I'm only trading $40, right? I'm only trading $40, and that's it. To me, the lot size is, if you want to be technical and get into all that knowledge, that's important to you. But at the end of the day, I'm trading $40. All right. Here, I'm trading 200. I have a $200,000 unit size in the market. But in actuality, I'm trading $20. $20 per pip. That's all I'm trading. So, you guys can get technical and get into all the unit sizes if that's what if you really want to know this information. But I don't know that's really important. I think it's just important to know the dollar amount that you're trading. But the leverage of lot size basically means that you control a certain amount of units in that particular market, and that's based off how much money you have in your account. So if I have $1,000 in my account, they may only give me a $2 or $3 or $4 unit size, lot size, I'm sorry, unit size to trade. With if I have $10,000 in my account, well, now I can go up to trading $30 perhaps, $25, $40 perhaps, depending on the pair. Each pair has their own leverage requirement. So that's also important. You could trade the US dollar and the euro. They could have, that pair could have its own leverage requirement, you know. And then I go to the pound USD, it might have its own leverage requirement, and you have to know that, and it's all based off the lot size. And you know, it's pretty cut and dry. But you know, again, there's some platforms like I don't use Thinkorswim to trade Forex, but I do have a Thinkorswim account. And when I first got started, and that's TD Ameritrade, and when I first got started trading with them, I tried to trade Forex on TD Ameritrade, and I just didn't understand their lot size. I mean, because they're not they're more of a stocks options platform, in my opinion. I mean, you definitely choose your own broker, but for me, I didn't like trading Forex on that platform. So find a platform that's easy for you to understand, one that you can easily see what's your lot size versus the dollar amount that you're trading. All right, and that'll make your life a lot easier when it comes to trading. Pips. Pip is the unit of measurement to express the change in value between two currencies. And that basically means that a pip is like I said, a unit of measurement that tells you the change in the pair. So I would say a pip is the number of how you make money in this market. You multiply the pips that you make times whatever your lot size is. All right. And people like to measure pips. Most traders that you'll talk to, and most traders that how they market themselves, they say that they make a certain amount of pips in one day, and they can guarantee this amount of pips in one day. And I don't count pips. I mean, when I first got started, I was mainly concerned with pips. Oh, I need to get 100 pips a day. I need to get 60 pips a day. I need to get a certain amount of pips a day. If I get that certain amount of pips a day, you know, I can live off this. But pips to me are not that important. To me, what's important is what I'm making. And that's why I trade. I trade for a profit. I don't trade for pips. Some people sell pips. That's their you know, that's just not my thing, and that's not what we teach here at Noble Star Trader. We don't care about the number of pips. We care about the number of dollars that we're making. That's why we trade. We don't trade for pips. So pip is the change in value between one pair and the next, and you'll basically get this. This is not that difficult. You'll understand this. All right, we'll get into some indicators and some type of indicators. Fibonacci retracement and extension levels is basically the difference in when a market change, the basic pivot points in the market. All right, moving averages. You've all heard of this if you've ever watched CNBC or any money and news station. When they talk about certain charts, they talk about, you know, they may say the S&P is has just crossed its 200 point moving average or something like that. They always talk about moving averages, and so that's just an indicator that a lot of traders use to measure what's going on in the market. You know, and that measurement is based off what has happened in the past. what has the market done in the past. All of these indicators are based off that because history tells us what's going to happen in the future. It's no different from going back to the doctor analogy. You go to the doctor, and when you're in the waiting room, the doctor's asking you, or the nurse is asking you, can you fill out this form? On this form, they're asking you about your mother. They're asking you about your father's history. They're asking you about their blood pressure. They're asking you about your bloodline. And you might, when I was younger, we were younger, we might have asked ourselves, why are they asking us all these questions about parents? I mean, what does that have to do with me and my sore throat today? Well, it's no different in trading. We want to know what happened in the past because that gives us a good indication of what's going to happen in the future. Where has price changed in the past? Because that's going to give us a good indication of where price is going to change in the future. So all of that is very, very important when we talk about trading. Very, very important when it comes to these indicators, the oscillators. You got the stochastic and the relative strength index. Very important indicators. These chart patterns, double top, double bottom triangles, these are actual candlestick patterns, not so much indicators that you can plot on a chart. Elliott weave theory are candles. It's a more in-depth indicator. And the harmonic price pattern is also an in-depth for you guys that once you kind of get a basic level understanding of indicators, this will be a good, this is some more advanced level indicators that you could try. I will say I have these on here specifically just to give you guys ideas, but I do not use any of them. But it's good to just throw a lot out there. What we teach is we don't want I'm not gonna teach you my trading style. Now, if you want to learn my trading style, you're more than welcome to learn it. But we don't teach that. We teach what works for you, because what works for me may not work for you. So you have to know, you have to develop your own trading style and strategy. But we give you enough to help you develop that trading strategy. With the understanding that the most important strategy is reading what the candles are telling you. And we have a popular saying where we say, trade what you see. And that's it. I mean, when you trade what you see, you are more successful. Trading what you see on a chart. You don't need a candle, you don't need indicators to do that, but it helps you to make better trades. All right. All right, we're getting into the trading environment. All right, this is very important. We talked about who's in control. All right, this is how we know. Okay, the market started here, right? The market went down here. Now, it didn't cross this low. All right, this was an indication that, okay, the market was trending up, went down, went up a little bit. All right, so the market got to this. This was the previous low. All right, so then it started to come down. It came down, it went up. But when it went up, right now we don't know that it's a downtrend because it couldn't cross below this previous low. All right, now when it came up and then it went down here, it crossed it then. Now we know, okay, wait a minute. It crossed this low and it crossed this low. Okay? So now we have a good indication that this could be a downtrend now. This could be a downtrend, all right? So if we know that this could be a downtrend, then we have two ways to trade this, and we'll get into that. I'll get into it right now, but there's several ways to trade this, right? One way would be to trade this is, okay, once this trend broke through this last point here, the previous low, and then it broke through this previous low, now we can trade going downward. All right, we can trade the downtrend because we saw it broke two lows. How do we trade that? There's two ways. Once this trend pivots off this point and goes up, we can say, okay, we're gonna place a safe trade here at this line. All right. So that when the market comes back to this point and breaks this low, we're going to trade downward. All right, so the market went back up, it bounced off this line, and it went up. All right, now, because it broke this low and it broke this low, now we have the idea that, hey, this trend could be over. And it also will depend on what these candles are telling us also to know if the trend is over. But we say the trend is over. How we trade is, we told you one option. This is one, okay? This is one option trade. But how we trade is option two, okay? And that is, we will place a trade somewhere in here. More than likely, we will place it at this high right here, at this close high right here. Remember, we said the close is most important, right? So we would place that trade somewhere at this previous high once it broke there, and then we would trade it down to the downside. All right, down to here. Your trade, if you took trade one, your trade would trigger right here. Your trade would trigger right here, and you'll make this money's right here. All right, knowing that the market goes up and down. Let's go back. All right, talking about trends, trending market. How do you know it's a downtrend? Well, this is how we know. It goes down a lot, it goes up a little. It goes down a lot, then it goes up just a tad bit. Then it goes down a whole lot. And then here, this way it gets tricky, all right? So it goes down a whole lot, but then it comes up a lot, right? However, it did not break this previous high, right? It came up a lot, but it never broke this previous high. So guess what? The trend is still in effect. The only way we knew this trend had ended, or it was possibly over, because it broke this high, and it broke that low, and it broke this low. This is how we knew that the trend could possibly be over, because it broke two previous lows. All right, but here it didn't break this high, so the downtrend is still in effect. If we never saw none of this, right? If we got to the point where we saw it got here and it started to come down, at this point we don't see none of this now. At this point, we can conclude that, hey, this trend is probably still intact. All right, so come on down this way, come down a whole lot, and then when it comes here, it comes up, still didn't break this high. The trend is still in effect. But what's happening in this area right here? What's happening? What's happening here? All right, what's happening here is exactly what's happening over here. This market is in a range. All right, this is a trending market from here to here. This market is trending. All right, it's trending in that area. All right, and then from here, let's say from here over to that place, it's ranging. Now it's in a range, and you have to know what's the sentiment. It goes back to the sentiment of your market. This market is ranging. It's going up. It went up. You know, it comes down here. It goes up. Come down here. It goes up. Come down a little bit. It goes up. It's ranging. All right. There are ways to trade a ranging market also. But in order to trade a ranging market, you have to first know that your market is in a range. Okay? You have to first know your market is in a range. And even in the range, you have to know who's in control. Well, when this market came down, it started ranging, or you might have heard this before, called consolidating. It's consolidating, but guess what? The sellers are still in control. Why? Because we have this trend line right here That's telling us that the sellers are still in control, because we have a trend line that the sellers have placed here that they're going to say we're selling here. It come here, we're selling again. It come close, we're selling again. It touch this line, we're selling again. Oh, it touches this line here again. Guess what? We're selling again. Oh, it comes here and touches again. Guess what? We're selling again. So there's still a downtrend even in this range. And so you have to understand that as a trader, you have to understand the sentiment of your pair. All right. That's what we talk. Well, that's what we mean when we say the sentiment. All right. The sentiment of this market here in this area is ranging market here, right? The sentiment here over here is trending downward, downtrend. All right. Surf's up, dude. Ride it down. That's a nice ride. You know, I don't know how many pips is in here or what these candles represent, whether it's hourly, monthly, weekly. But let's just say you place what we call the perfect trade, where you enter, let's say you enter here, right? Or maybe you enter here. Or even maybe you enter here. Or let's say you traded that right there, that low. Or you traded this low. All right? You might have got a little fearful if you traded this low and it went here and it came back up against you, you might have closed. But guess what? Look at all that. And that's what we talk about, fear and greed. You have to understand what you're doing, because if you're fearful in a market like this, if you trade this and you don't know that the market's going to go down and it's going to come back up and retest this area. And that's what it did. It retested your entry point. If you're fearful at that moment, you're going to close your trade and you're going to be mad at yourself, because you could have closed the trade all the way down here when it got down here. But you say, you know what, I'm going to ride it all the way out. And in doing that, it came against you. And so you got a little fearful, and guess what it did when you close your trade? It went all the way down. You're going to be mad. You're going to be very disappointed. And that's why we have training lessons for people like that don't understand the market and the candlesticks. All right. So this is the trading environment. Very important to know. Going back to the market sentiment, also very important. All right. Support and resistance. It's important to note that the support and resistance are not exact numbers. They're areas. All right. Reporting resistance are areas. So this is a particular support and resistance area. All right. It's not a specific place, but it's an area. So let's say, for example, this is how we explain support and resistance. All right. Let's put a line here so you can better understand. Since we just saw a trend line. And I'll put a line here so you can better understand too. All right. So market went up here, resisted this point. It resisted. The seller said, nope, this is our line. We're resisting anything that comes to this line. So came down to the support line. The buyers were at this line, said, nope, we're not having it. You better go up there. Sellers again resisted that price point, shot them back down. Buyers, their line is still intact. The buyer's line is still intact. Said, nope, go back up. All right, same thing here. And let's say, for example, when this price came from here, resisted here, it broke through this line. Let's say it came all the way down to here. And let's say this imaginary support line is all the way here, right? All right. So let's say price came down and hit this line and came back up to here. All right. And let's say this is an imaginary line right here. All right. So we still got this line, which the buyers were at. The buyers said, you know what? This is our line, and we're defending that line. And then you had this line where the sellers were at. They were defending this trend line, and they were also defending this price point. So it's two things they were defending. They were defending that trend line and they were defending that price point. Now the market went down again. Back here, the market went down, passed all those lines, hit this, came back up, and it got to this point here again. All right. All right, so it came down, hit this line here, and bounced back up. All right. And you have this line here. And you have this line here. Right? All right, so the price came here, retested this line. This is still a resistance line. How do we know that this line is a strong support line? All right, so it says here, the more price tests an area of resistance or support, the stronger that line is. Well, we know this area is strong because it tested it again and it bounced off of it. All right, so then price came here and it got to this point, and maybe it came back down to here again. And maybe it went to this line again, and maybe it bounced off of it and it ranged. Boom, 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 and it broke through. All right. So now we know this is a good support line because it bounced off of this in the uptrend and the downtrend. So we'll keep this line here. I like to mark these lines on my chart because I know they're strong resistance and support lines. This lets me know that price may go all the way down here for a month, 2 months, a year, whatever. But at some point, the market may come back up, right? And if it comes back up, I want to always have this line here. So I know in the past, this could be 3 years, 4 years, this could be 5 years later. But as we talked about originally, when you go to that doctor's office and they ask you about your mom and dad, I want to have all that on file, just like the doctor. The doctor want to have that information on file. So if something happens to you, they know about your past, your bloodline. That's why I plot these lines and I keep them on my chart so I have them on file. So I know about my parents' bloodline. I know about my parents' history. I know what my parents done in the past. That lets me know what it's going to do in the future. Okay, so all important stuff as it relates to these pairs. Support and resistance is equally important to note and to understand what's going on in the market and where the support lines and where are the resistance lines. All right. We're talking breakout trading here. All right. So we talked about this previously where, okay, here's the previous low. All right, that was the previous low. And we said, when the market breaks this line, we're going to trade this. We're going to trade this. And as we can see, this is a very important line because if we take this line from here all the way to here, we can see there's something there. Price came up, bounced off that line, broke through it, came back down, stalled a little bit. Those of you who are in my candlestick analysis class, you'll understand why these candles did this at this particular time. Came up, kind of straddled that line a little bit, came up, couldn't close below it, came up, tried to go below it, couldn't close, came up, and finally closed below it. Well, if you had a trade, you can tell at this point right here, if you saw none of this here, you already know that this is a very important line. You already know that because of what has happened previously. What was on the doctor's history. You already know that this is an important line. So you can say, you know what? When that price gets above that, I'm going to place a trade right here on this line. Right here, right? And you got a nice little break on that one. Had you traded that. So that's called trading a breakout. We talked about that briefly, but the term for that is trading a breakout. That's what that means. Trade a breakout. Likewise, if you had a line here and you said, okay, when price gets above this line, I'm going to place my trade right here. All right, so I'm gonna make it up. I'm betting on the market go up after this line, and once it get past this line, I'm trading it up. And if you did that, you got a nice little trade there. So these are breakout trades, all right? And here you have an example of, here there's a stochastic. This is a stochastic right here. And this one with the green lines, this is called MACD. And this just gives you indicator that tells you how strong the momentum of the trend is. All right. And we'll get into, more advanced level training on these. But right now, you notice how far these lines are apart from each other. That tells us that the momentum of this trend is strong. All right. When these lines break apart like that, that tells you that the momentum of this downtrend is strong. And as you can see, that was a pretty strong move. If we measure the point from here to here, that's stronger than any of these points like this. Any of these from the low to the high, this move right here was stronger than all of them. And it's identified in this this momentum index here. So that's what the underlying indicators are. The MACD, the stochastic, they give us momentum, and they're momentum indicators. They tell us the momentum of the pair we're trading. They tell us the momentum of the trend. And each one has its own way of telling us that, but that's what they tell us. All right. Trading divergence. All right. Here's another trading style. Okay. This right here would be price. All right. Consider this the price. These are the candles. And here's like the stochastic, what we just showed you at the bottom. This is the underlying momentum index. All right. So price goes down, goes up, down, up. All right. And so we see this right here and this right here. All right. So price came down, it went up, and it came down, and then it shot up. All right. So when I first started trading, this is how I started trading. I use this as a trading indicator. All right. I would pay close attention to this. All right. So if you look at this momentum index and you look at this low right here and this low right here. All right. So what's the difference? This low, this is a higher low, and this is a lower low. Well, right here is a lower low, and this is a higher low. See the difference in divergence in these two and these two? This lets us know that the momentum of this pair is up. And guess what happened? The price went up. Now, how would you trade this? As we said before, you can draw a line here, and you can be a breakout trader, and you can say, okay, when it passes this line, I'm gonna trade the breakout. Or like we trade, once we identify that the market has broke this line, we wait for it to retrace. And this is what they call a retrace. Market will break this line, and it'll come back and retrace. And we'll place our trades somewhere in here. All right. Not at this specific point, but it'll be, it could be somewhere in there. Somewhere as far as there. All right, we'll place our trade to the upside. We got the indicator here at the bottom. We got the divergence. It told us that the momentum of this trend was up because it had a higher low, but on the chart, it was a lower high. All right, so we'll wait for price to come back and retrace. We'll trigger it here. We'll take a nice piece of change going up that way, right? Likewise, hidden divergence. That's called regular divergence. And we have another indication called hidden divergence, where Price is making up. It's got a lower high and a higher low. But on the stochastic, the momentum index down here, it's got a higher low and a lower low. Okay? So there's a difference between this point here and this point here. All right? Again, several ways to trade this on the hidden divergence. You can draw a line here, and if you trade it like this, hey, looks good. All right? And in some cases, me being a retracement trader, I probably would have missed this because I would have been waiting for the market to come back and retest this line. But it looks like it just kept going. So in this case, your trade was a good trade if you traded the breakout. On this case, your trade was not a good trade, trading the breakout, because it went back against you. And again, it depends on where your stop loss is. We'll get into that. It also depends on your nerves as a trader. If you're okay with placing this trade and seeing some progress, and then it comes back against you all the way down here, this is gonna be frightening to you at this point in the market. This is gonna be, man, trade just, oh, it's going against me. I want to close it. But then, if you pay attention to what you see and you trade what you see, you got confidence in this area. You're not fearful. You're confident because you know you saw this. You saw the divergence. You saw what was about to happen before it even happened. You saw the history. You read the report about their mother and father. You know about the diabetes in their family. So when you got to this point, you was confident. You weren't fearful. All right. And so you rolled it all the way out because of that, because you saw the history. So again, the history of a market is very, very important. All right. All right. So what type of trader are you, or what type of trader do you plan to be? All right. So quite simply, scalpers, it's a fast-paced, exciting, mind-rattling, all at once types of trades. And it is it's not fun sometimes. It's not fun trading like this. It can be very scary being a scalper. These are trades that are placed on like this one talks about a 1 minute and 5 minute chart. I wouldn't even look at that if I were you guys. I would start with at least 30 minutes to an hour. If you can't wait 30 minutes to an hour, then you probably don't need to trade. Most of the millionaires, they trade the 5 and 15-minute charts because they want to make tons of money in a short period of time. Most of the millionaires, they may put a trade on for like 5 minutes, but they're gonna make tons of money in that 5 minutes. For us, depending upon what kind of money you have, $10,000, $20,000, you want to get in more of a longer term day trader. That way you can take advantage of the long-term trading strategy, because you just don't have enough money to make a lot of money in a short period of time, and so that's just an advice I would give. But hey, you definitely welcome to trade how you like and whatever is comfortable for you. I know our trading style is more of a day/swing trading style. And that works for us. But like I said, you have to know what works for you. Okay. What else can we talk about? The swing trading. Swing trading is a long-term trading style that requires patience to hold your trades for several days at a time. You have to be patient. Again, you have to be patient. You're talking about a swing trader. You're gonna be. You might get into your trade on today, and you might hold that trade from today all the way to next week. All right, you're gonna hold that trade to next week, and that can be difficult. If you're not patient, If you are, you know, you don't have the patience to hold that trade and just to see what happens between now and next week, that might be a tough trading strategy for you. I'm sorry. You have to know yourself, know your strength as a person, know know what you like and know what you dislike, and that's going to be ultimately the determining factor of what type of trader you are. All right. Position traders or long-term traders, they hold trades for a month. I would not advise that for newbies, but we do have strategies out there for those of you who like to trade like that. Because that's like from a macro level. You have less opportunity to be wrong trading in that time frame, but you have to understand that when you're trading that time frame, you're talking about thousands of pips in 1 month. And if you can't trade with a lot of large lot size, you have to trade with a small lot size because the market moves so much in that 1 month. So definitely trading strategies for you. You just have to know what you are and your strengths and weaknesses as a person. All right. Placing trade with risk management. Most important part of this slide. Okay. This is the most important slide of all that I've talked about. All right, guys, you have to live to trade another day. Period blank. You have to live to trade another day. You do not want to be a trader that puts everything into one trade and you're like, I'm all or nothing. Do not be an all or nothing type of person. All right. Or you'll be one of those type of persons that you read about in the news or you saw on TV where you're jumping off a bridge and trying to kill yourself because you placed everything that you in your life savings on one trade in 1 day. Do not do that. All right. Most important rule in trading is to live to trade another day. Because hey, if I'm trading right now, and as I'm talking to you right now, a trade just went against me, and I close it before it gets too bad. Because not every trade is going to be positive. All right. Some trades are going to be good. Some are not. You just have to know that. Today, I'm looking at my trades, and I've got 1, 2, 3, 4, 5 trades. I've got 5 trades today. 3 of them went against me. All right. My profit is $800 today. Not the best, but I've got $1,000 trade, a $350 trade. I've got a $200 loss, a $150 loss, and a $230 loss. Okay. But hey, I'm still in the positive. And that's what you have to be. You don't want to let your losses go to 400, 500 if I'm trading the way I'm trading now. I can't afford that. All right. So you have to limit your risk. Limit your risk. Stop loss. Be sure to manage your trades with the stop loss. That's very important. Stop loss is just when you place a trade, you make sure you put that a stop loss is when the market goes beyond this point, your trade is going to close. All right, so you want to close those trades out to keep them from losing you money. You don't want to lose your money. You want to be profitable. Do not be in the 90%. 90% of the people don't believe in stop loss. They just trade to make money and not recognize that there's a possibility they're going to lose money. All right, stop losses are very important. Stop it before it gets bad. Leverage less than, it's a rule that says leverage less than 1% of your account. So that means that if you're trading with $10,000, you should be trading with no more than $10. All right, you should leverage. I'm sorry, you should not leverage more than $100. That means that when you trade and a trade goes against you $100, you should be closing it out. All right, so that's a rule of thumb. Okay, 1% of your account. We do 5 because we're more aggressive, but we also teach 1. For our newbies, we teach 1% because we know what they need. we have been in this business for a while, and we understand most often times than not, we never get to 5%. Even though we have a leverage of 5, we never get that far because, like I told you, I'll close a trade before 1%, before my 1% is hit. If I feel that it's not getting there, yes, I'll have a stop loss of 1%, and sometimes I may have a stop loss of 5%, but it never gets there if I feel the sentiment or the market is moving in a different way than I suggested. I'll close it out. Why allow a loss to just keep going and going? And sometimes you're gonna be right and sometimes you're gonna be wrong, right? But the most important part is the first bullet point: live to trade another day. Another one is scale into your positions. Like most of us, when we go to the pool in the summertime, before we get into the pool, we'll put our toe in the water to test it out. Most of us, we don't just go and do a cannonball like we did when we was 15. We'll put our toe in, just to wiggle it around, see how cold the water is. And if it's extremely cold, we may go to the rail and we'll kind of slowly get in, and slowly get into the water. It's no different in trading. If your lot size, if you have a maximum lot size of, let's say, $15, you want to scale into that position $5 at a time, maybe $3 at a time. Maybe you're gonna place $3 here. Maybe you're gonna place $3 there. Maybe you're gonna place. Let's go back to this analogy, and let's say if we're trading this, let's say we want to trade this. Maybe we're gonna put our first $3 here. That's 3. If we got a lot size of 15, and let's say we'll put our next 3 here. I would put 10 here if I was trading. I would put 10 here because I believe it's going down. And then when it passed this mark, I may put my last 2 here. All right. So I put 10 here. So I'm making $10 on this long move right here, right? Now when the market goes against me, I'm even with this 3, and the 2 is the only one that's really hurting me. But I got 10 from this point to this point, right? So when the market goes back below my 2-point range, oh man, I'm really feeling good from there to here. You see, that's what I mean when I say scale into these positions, all right? You want to scale into these positions, and you have to know how to scale. That's something that we teach. We teach you how to scale into these positions. But I would say the most important rule, and I have it in bold print for a reason. The number one reason new traders fail is not because they suck. It's not because you don't really know what you're doing. A lot of people, they really do have a knack for this. They understand it. Some of you guys may have already traded before, so you understand trading. You understand the basis of trading. But because you are undercapitalized from the start, you don't understand how leverage really works. Because you don't have enough money, and because you're only trading with, let's say, $5,000, and your maximum leverage is $20, and you putting $20 on every single trade you make, because you don't understand how that's killing your account, and you don't know how to scale into positions, you're gonna lose. You're gonna be a part of that 90%. And that's harder to do, easier said. Because if I know, man, this is a big news event, I can make a lot of money on this event if I just leverage all of my account, I know what the market's gonna do. Well, I'm gonna tell you what happens on big news events. And for those of you who have traded before, right before that news event start, the market gets wild. All right, it'll go high, low. It might go 50 pips high and then 50 pips low. When you see that market go 50 pips low and you've leveraged all of your leverage, let's say you can trade 20,000, you leverage all of it, it's going to cause you to want to close that trade. And when you close that trade, you've lost. Now you got to make back the money you've lost because you over leveraged. But the problem now is because you over leveraged from the start, you don't even have $20 to place on the next trade because now you've lost money. So now your leverage is lower. Now you only able to leverage $15, for example. Now it's even harder to get that money back that you've lost because you over leveraged from the beginning. And that's like a spiral effect. Now it becomes emotional. Now the emotions of, oh, I got to get my money back comes into play. And it's just not good. That's a terrible place to be in the market. So, guys, this is there's a lot of things that is left to be said here, but the most important thing is this is a basis for your understanding, and I left this last slide as the most important slide because I think it's very important for people to understand why there is a 90%. This is why people trade too much in one day. People don't have a stop loss. People don't understand how to scale into the position. Equally important, people over leverage their accounts. Okay, so there's so much left to know about trading in the Forex market. I couldn't go over it all in one day. I mean, here I've been talking for over an hour and a half about this, and there's still tons left to learn. And so we definitely offer options for you. We have our Forex trading for beginners. It's $75 a session. And when I tell you guys that this one is very in depth, this session, there's about, I think there's five sessions in this Forex trading for beginners. So it's gonna cost you about $350 to get through it. And when I tell you that's not a lot, I mean, when I first started trading, I lost $1,500 when I first started. And when I first started, I was looking for someone to help me with my trading. I was looking for someone that's willing to give me a one-on-one. Well, these sessions are not one-on-one, but I was looking for a mentorship. All right, I was looking for someone that was going to teach me how to make trades. Well, the most important part of it. And unfortunately, I didn't have anyone in my circle, and I didn't know anyone. So I was looking online. I actually paid for sessions more than $350. I actually paid for sessions to learn about stocks because there just wasn't enough content for me about Forex trading, and I didn't trust it all. But we have webinars ongoing. Most of these sessions will be webinars where we'll go over content similar to this, and you'll have the opportunity to ask questions. I'll answer the questions, or my partner will answer the questions. And our goal is to help you become successful in the market. That's it. There's no other. We succeed when you succeed. When you're successful, we're successful because we've gotten someone else that can profit in this market. All right. It's to us. I mean, to me, it's not hard. It's really not hard to do it. But I do understand why there's a 90%. I do, because I was a part of that. And what happens, the part I didn't tell you guys, is what make up that 90%. People get in because they know they can make money quick. And when they fail, they go back, they fail again, they go back, they fail again, and then they quit. They don't have that persistence. One, they don't have the coaching. They don't have someone to really show them and teach them. And then they just don't have the persistence. And maybe they had a wrong trading style from the beginning. So we're here to assist. These are, I could easily be charging upwards of $600 for these sessions, but I want them to be at a price point where people could afford. If you guys don't take advantage of any of these products, you have to take advantage of the candlestick analysis. And that's why I have it at $50 per session. That's going to be about 4 sessions going over candlestick analysis. And this is, to me, is the most important part of trading. Yeah, the indicators are good. Yes, trend lines and resistance and all that is important. But candlestick analysis, um, if you don't know anything about the market, you definitely want to take the Forex trade. And if you take that, I'll knock. I mean, you can do the candlestick analysis course for $100. I'll give you the 4 sessions for $100. Um, but the most important thing is, guys, you have to understand everything. You have to. It's almost like you're going back to the doctor analogy. It's like you're going to perform surgery on someone and you don't have all the knowledge to perform this surgery. You're not going to succeed. You're going to fail. It's not even a, you're going to fail. That person's going to lose their life, and it's not going to work for you. You have to have understanding of what you're doing to be successful. It's not just going to come by you watching YouTube videos, and it's not going to come by you just trial and error. I did that. Okay, I'm not saying I'm the smartest person around, but I've done that. I watched tons of YouTube videos, and I'm gonna tell you what happens when you watch YouTube videos. Everyone is selling you their trading strategy, right? Everyone's selling you their strategy. Oh, this is how I do it. I get 60 pips a day, or I get 100 pips a day. And you're gonna watch all these videos, and you're gonna have like 10, 15 different strategies, and you're not gonna know which one to use. And that's why we don't teach that. We teach you how to develop your own strategy from simple tools and rules that you use to place a trade. We have simple rules that, no matter what strategy you have to have rules before you place a trade. You have to know certain things about your market, and you have to have certain criterias before you place a trade. All right. Likewise, the doctor is only going to do surgery on your knee if your knee is broken in some type of way. He's not going to do surgery on your knee if your knee is not broken. So likewise, you shouldn't make a trade if you don't have your rules, or something's not where you want it to be in the market. Okay. So candlestick analysis, I will knock off $100 if you take advantage of one of our trading strategies. Day trader is very good. All of the sessions are 5 sessions, and very informative. Like I said, we're going through webinars. We don't give you videos, which is, I won't call any names, but someone I was following, who I was paying money, I was paying him like $200 a month to learn, and all he did was send me videos. And the video just didn't answer the questions that I needed. You guys are gonna have questions now. You may have questions now you have for me, that they're going to get unanswered because this is a video that I'm sending you. So webinars that we give are informative, and you get some back and forth with me or my partner, and you get to ask questions. You get to grow your knowledge, not just by me feeding you information, by you also responding and asking important questions that you have about certain things that we're going over. So all good stuff, guys. Very important for your success in this market. And at worst case scenario, we do offer live trades for you guys that have been in the game for a while. We offer live trades and trading signals. This is $50 a month, and this is, you're a part of our team. We have a chat room where we'll send you or we'll text you. We have a group chat where we text out our signals in the group chat. We also chat about different pairs that people are trading, and that's not related to the trading signals. That's just, hey, I'm trading this. Hey guys, you guys want to jump in on this trade? I'm trading this. So this is a live room that we have where a lot of traders are like this, because some of our signals are discussed in this room before we actually send them. We might be talking about a particular setup, and it's just good to be amongst traders. I mean, for $50 a month, you're gonna make, that's a drop in the bucket for what you're gonna make from our signals. I mean, one signal will get you $50. Seriously. And you're going to get at least 2 to 3 signals a week. So, all good stuff. If you're interested, definitely. If you're not interested and you like the content in the video, give us a like. Give us a like on Facebook, Instagram, we're on Twitter. You could definitely sign up if you're interested on our website. You could drop us a note and email if anything in our video you felt we needed to add, or we any comment you may have for us. Drop us a note and let us know what you think. Otherwise, guys, enjoy going over this lesson with you guys. Wish you guys all the luck and success in the trading market. And as we like to say, happy trading.